inventory has been damaged or spoiled or just become obsolete, then it'll take an inventory write-off charge. You'll sometimes hear that a company wrote down an asset. That means that management decided that the items are no longer worth their balance sheet values. As we work our way down the balance sheet, we'll eventually come to a line that reads total current assets. You know what that is. It's just the total of everything above it in the current assets section. The language of accounting tends to interpret current as meaning within the next year. So these are things the company owns that the company expects to convert to cash within the next 12 months. Moving farther down the balance sheet, still on the assets side, we'll find something like property, plant, and equipment. You understand this already, don't you? It's the value of all the company's property, plant, and equipment. That would be things like administrative structures, manufacturing facilities, tech equipment, land, stuff like that. Below property, plant, and equipment, you'll find a line labeled accumulated depreciation. That's tougher to figure, but given that it follows property, plant, and equipment, it probably has something to do with that property, plant, and equipment wearing out. Take this line with several grains of salt because accounting rules just can't handle all of the different ways that different things wear out, or more accurately, decline in value. Computer chips decline fast. The value of a building might even increase, especially if inflation is high. The end result is that assets are often worth quite a bit more or less than the balance sheet says they are. We don't have the time to go over much of the liability side of the balance sheet, and you'll find that you can reason your way through most of it yourself. Again, we're not trying to become certified public accountants today. We'll concentrate on the line that reads total stockholder equity, or perhaps total net worth. Total stockholder equity can change. One way is for owners to put more money in the firm. Another way is for the company to earn a profit and keep the money in the firm, usually by plowing it back into productive assets. You'll usually see the owner's contribution listed on a line named something like common stock. Remember, the liability side of the balance sheet keeps track of where the company got its funding. Sometimes you'll see a line labeled retained earnings. That's the money that the company earned and reinvested in the firm. That's why it's on the balance sheet liability side. It's a source of money. The retained earnings entry doesn't represent a pile of cash that can be tapped. If you want to see how much cash the company has, then look at the cash entry. Retained earnings are much more likely to have been invested in new productive assets like trucks and factories instead of being put into cash. The income statement is the second important corporate financial statement. It's the company's answer to the question, how much money did you make? If someone's looking for a company's report card, then he typically turns to the income statement. As I mentioned at the outset, Jay Taparia likens the income statement to your personal tax return. To oversimplify again, you list your sources of income at the top of your tax return, sales or revenues in the case of a company. Subtract your deductions like personal exemptions, business expenses for a company, and the result is your taxable income and income before taxes for the company. Notice that an income statement isn't a snapshot like a balance sheet. The balance sheet reflects a company's position at a specific point in time. A tax return or income statement spans a period of time, usually a year for a person, but often a quarter for a company. Like the balance sheet, the income statement requires accountants and analysts to make a lot of assumptions. For example, an income statement's figure for reported sales assumes that a certain amount of those sales will be returned and that a certain number of people won't pay for them at all. That assumption makes sense because returns and bad debts happen. But that doesn't mean that the number on the income statement isn't an estimate. Another reason income statements are estimates is that accounting procedures usually require land to be recorded at its cost. Over time, especially with inflation, the value of that land probably increases. That increase in value doesn't appear on the income statement. The first line on an income statement is usually either revenues or sales.